Okay, though. Yeah. Just as an introduction, this is not meant to be an academic course and discussion. Yeah. Because if you want to, there are a zillion ways of valuing companies or valuations. And if you want to have a course on that, it could take a week to do that. So for myself, I wanted to present today kind of simple and practical stuff. Yeah, it's experience-based. Yeah, as Christoff mentioned, I brought 3 companies public, one of them to the Nasdaq. I had Bill Gates as an investor in one of my companies. I had very highs and very lows. But that gave me quite a bit of experience, and it's my joy to share that with you guys. I invested in my past, and I had 2 venture capital companies as a majority shareholder. I invested like at that time in about 50 different businesses spread all over the world. At this moment, as Christoff mentioned, I'm actually doing most of the interviews on potential investees for the hedge fund. Yeah. So that gives me quite a bit of experience to share with you guys. Yeah. For me, the preferred outcome of this seminar would actually be that you're able to calculate your own valuation, a simple valuation based on your financial plan. Because if you'll be able to do that, actually you have a base for discussion with your venture capitalists, with your investors. And of course, it's all different in the phase you are in, and it's fantastic that we can have that kind of polls that we just had, because it's a bit different reasoning once you are looking for money and you're still in the conceptual phase. It's quite difficult raising money there. Next slide, please. Yeah, so it's the different company phases and the money you're looking for. It's actually all about dilution. Yeah. The aim is to keep as much shares in your hand, but have also a fair deal with your investors. When you're in a first phase, as most of not most, but a lot of people here are, which I call the angel money phase. Yeah. The range you could give away, in my opinion, is between 10 and 20%. Because if you give too much away right now, yeah, and in the second round, then you will be so much diluted that at the end of the game, actually nothing is left for you guys. Yeah, and in that what I call angel money phase, the people you're usually going to, I call them the 3 Fs. Fools, friends, and family. Yeah. Not that much professionals will invest in you. So you need to go into your network, your current network of friends and family and business associates. Yeah. The next one is actually but more serious. Then you usually have to do with more professional people. I call it seed and Series A around, and there you can give away between 15 and 30%, in my opinion. Usually the investors that are investing at kind of spaces, they call them early stage VCs, venture capitalists. Yeah. The next round actually is actually more for later stage VCs, and you can see here also there you're ending up with giving away between 15 and 30%. Yeah. So that's, before you think about an exit, yeah, selling the company, then actually you're giving away between 40 and 80% of the company. Yeah? So that means that at least at the end you own still 20%. Yeah, in the worst case. If it goes lower than that, fine, but it's all a matter of motivation, and it's your baby. You brought it that far, and actually the major beneficiary should be you. I started up many companies in my life, and I assisted lots of people starting up their company, and as you know already, all of you, it's blood, sweat, and tears. Yeah, it's taking risk and sleepless nights and working day and night. When I started my first major company, you know, I worked on average between 80 and 100 hours a week. Yeah. Which is not that unusual when you start up a company. And we took huge risks. Yeah? I mean, I signed personal guarantees, yeah, for about 500 million Belgian francs at that moment, which is close to $15 million. Yeah, a personal guarantee. That means if I would have been, if the company would go bust, yeah, then I would have been bust personally as well. But venture capitalists like that. They like hardworking, driven people that actually fight for their company and actually risk almost everything for the company. Next slide, please. So it's the question is, how much should we raise? Yeah, it's again, it's a dilution game. It's all about dilution. Yeah. So before you go to the next round, you need to create as much value as possible, because then the more value you create, the lesser you will be diluted when you sell another part of the company. Yeah. If you calculate it too short, yeah, that means that you have constantly, you're busy with spending time on fundraising and less on time on the business. And it's catch-22. If you actually spend less time on the business, you know, the value doesn't go up. So think about it very well before actually you calculate your amount to be raised. Yeah. If it's too long, if you raise too long, yeah, then actually you're giving away at a much too early stage. Money shares away. That means, okay, you can last longer with the money you're asking for, but you're so much diluted actually that at the end, if you do another round and another round and another round, you're so diluted that actually you're not left with that much of shares. Yeah, I've had it in my past. You know, in the first major company I raised money for, the one that went public on the Nasdaq. We were actually negotiating with venture capitalists, you know, with a gun against our head, because if we would not have had that money, it would only take a couple of weeks before we were bust. Yeah, so that's not a comfortable situation. My partner and myself, we were left in the first major round. We were left with 30% of the shares. Yeah, happily later on, yeah. Happy and unhappy, the business in the first couple of years did not go as fast as we thought. So the venture capitalists wanted out, so we could buy them back with loans from banks and friends and family. But my message is calculate very well the amount you want, so you actually have a bit of reserve in time and time enough to create value. Usually, it's about 18 to 24 months before you go to the next round. Yeah, that gives you time enough to build value. Yeah, and be aware. Yeah, if you start fundraising, it takes time. It means that it's not because you start fundraising right now that within a month or two you have the money in your bank account. It usually takes, it's my experience, between 4 and 6 months before the money is needed. Yeah. On the other side, as I said already, don't do as I had it in my own first big company, the one that quoted on the Nasdaq. Do not risk to negotiate with a gun to your head due to lack of funds. I'm speaking out of experience. Yeah, it's a very uncomfortable position you are in, and you have to give away much more of your shares because people at the other side of the table, they smell blood. You know, even if you don't say it, you know, you radiate it. People feel it that you're desperate, yeah, and then they take advantage of you. Yeah. It's a game, but it's mainly a dilution game. As much shares as they can get on the other side of the table, they will take. Yeah. Next slide, please. Good. That's a bit of a graph that shows you the optimal duration for the next round. You know, on the one side of the graph, you have the ability to focus on business and risk hedging. So you create much more time if you wait longer for the next round. So if you take much more money to last that long. But on the other side, you're actually your dilution goes higher and higher and higher. And again, the same thing. It's valuation optimization. So your valuation goes down the longer you wait. Yeah. Next slide, please. Yeah, and a bit of advice there for me, and that's what I'm advising even actually to the people we're investing in. Keep at least 51%. Yeah, for series the series A, angel series A and B. Yeah, if you have a C and D later on, actually you can go below 51%. But you need actually to protect your baby. It's your baby. You need to grow it, and the 51% is actually it's not only for the value of the shares. It's not only for the money. It's because you have a vision. Yeah. You want to drive that vision, and if you are under 51% in the general meeting of shareholders in the AGM, then actually you can be overruled. Yeah. So your vision actually doesn't count that much anymore. Yeah. And be aware, we can have private discussions about that if you want. There are several techniques, even if you go share-wise under 51% to keep the majority of voting power, because that's actually the decision-making power in a general meeting of shareholders. So there are classes of shares where, and you can have a class of share when you have double or triple or whatever, it's to be negotiated voting power. And the voting power is then much more than the economical power. Yeah. Another piece of advice is if the chemistry doesn't work with your future investors, don't do it. I mean, I had it in my life. I had with all due respect, an investor in when we worked with a couple of venture capitalists first when we started our company, we had one that really was a pain in the ass, to put it even mildly, and that brought us actually to the brink of just stopping the whole company, and at a certain point in time. We had almost go to court to get him out. Yeah. So the best way to do is to create alternatives. Yeah. Don't negotiate with just one party. It's like with anything and everything. If you buy a second-hand car, and if you sell a second-hand car, if the other side knows that you're only negotiating with one, well, that's a difficult negotiation position. So for selling shares, actually just the same thing. Discuss with different venture capitalists, with different potential investors, and if you must, even try to set up a consortium of investors if they really want to get in. That brings you in a very good negotiation position. Don't negotiate only with one party, and if with one of the parties you're negotiating you feel that the chemistry doesn't work, don't do it. On the other side, look for what they call in the industry smart money. And that's actually people and parties that have a huge network, preferably a network in your industry, who has knowledge of your industry you want to get in and of your business, and where you actually can be, you feel you can be what I call business friends, where you can talk openly about difficulties, where you can get advice, etc., etc. Next slide, please. Now, what is an investor looking for? Of course, the first thing he's looking on for return on investment, and that's for an investor, it's capital gain. That means that if an investor is looking for capital gain, you need to know that this investor wants to get out after a certain time. And don't start negotiation, and I had it a couple of times, with saying that, you know, you wanted to stay with that company for the rest of your life. It is setting up a company is actually growing the company until you can sell it. A company is a product. That means that product is sellable, and that's actually the whole process. Usually, an investor wants to be out between 4 and 5 years, sometimes a bit more. But say that's the average. You know, if the HMAP as an investor gets into a company, we want to see the potentiality that the business can be sold to within 4 to 5 years from now. So that's, you have to show your exit willingness. That means that you have the same goal as your investors, and that means a profitable exit. Of course, the minimum when an investor will get in, the company needs to be, the concept needs to be viable, and it needs to be a viable and sustainable business model. You need to have a minimum viable product, and if you are in the concept stage, as some of you are, then actually it's a totally different ballgame than you go to the 3 Fs, the fools, friends, and family, and that's not really a calculation. You give away maximum between 10 and 20%, as I just said. But once you're getting to the first real round, then actually you need to prove that you have a minimum viable product and that you have some traction, that you're already selling. An important element, if not one of the most important elements for an investor, is the quality of the management. So your CV is quite important. They need to see in your negotiations that you have drive, that you want to take risk, that you work day and night. Also that you're not too greedy in certain aspects, and they call it sidekicks. If you put in, one of the things I'm looking at in the business plan or in a financial plan always is, the salaries of the founder or the founders. If that salary is way too high for the stage you are in, I'm just leaving. I say, okay, go somewhere else, but not with our money. So and I've seen it, I've had a business plan many years ago with somebody that immediately in his business plan had put in the capex an expensive BMW. That's things you don't do. Those are sidekicks that you need to avoid. So the quality of the management is utterly important. And with the HMAP even, we once we decided to invest, before actually investing, we have an online, personality test. So to know that actually our gut feeling is proven right by a scientific test, and we have somebody that does that for us in our company. And then of course your narrative of course need to be strong and motivational. You need to have a super duper pitch deck and being able to sell it. If you're not able to sell your company to an investor, how will you be able to sell your products and your services? Then, of course, a rock solid financial plan. That's for me the most more important than actually lots of text. For me, a pitch deck is fine. With good graphics, with good layout. But not a 50 or 100 pages of text, because that's, anyway, we know it as investors. Anyway, that's copy paste, or you create some text yourself, but lots is things you find on the internet and copy paste. So the financial plan itself, I'm getting a lot of questions. Can you give us a sample of a financial plan? My answer is always no, because every single business idea and business model is different. That means I see it immediately. As an investor, if you use one of those frameworks you can buy on the internet. Don't do it. Build your own business plan, get some advice from friends and business people, and if possible, your accountant, and build your own business plan yourself. We can give you some guidelines from the HWeb. If you want to have some guidelines, we can get on a call with you. That's where we are for. Our foundation is actually there to support you guys. Yeah. And then, of course, one of the things, if you're in technology, certainly if you're in technology, your IP needs to be protected. Yeah. Either by non-disclosure agreements with all the parties you're going after, and then once you have a bit more money, you know, file your patents if possible, if you have patents, if you can have patents. Also, your name needs to be registered. Have a unique name. Also, you can use it on as a URL. I've seen several companies that actually have chosen a name like xyz.co.za, and then if you check, you know, the name exists already in another country. Don't do that, because if you go global, or at least pan-African, you know, you need to have a unique name. Yeah. And as I said, no sidekicks. That's what I mentioned earlier. Next slide, please. So financial plan. For me, the ideal financial plan is parameter. That means that all the variables are in one tab. So then you're able, you know, to answer the what-if questions, and that comes over very professionally. You know, if you have a negotiation with a venture capitalist, with whatever investor, yeah, if they say, what if the price drops by half? And you say, just a minute, and there you go. And you have then actually it triples through to the P&L, use of proceeds, and things like that. You know, so you can immediately show them the effect of price erosion in that question. Or if you do not reach your numbers in quantities of products, sold products and services, or if your cost of goods sold go over the limit, etc. All those questions you will get. If you can answer that immediately, it's a big plus. And then, of course, a financial plan need to be backed up by solid research. Yeah. If you put numbers, and especially in your sales projections, if you put numbers in your financial plan, and it's not backed by research. Yeah. Say you have a product A, and you want to sell it all over Africa. Then you need to do research, you know, to define what I call the total accessible market. Yeah, and then you need to know how much people are living in that country, how much percentage of the people living in the country can use your products or services, or how much businesses are registered in the country, etc., etc. Back it up by solid research. If you get a question about, you know, your numbers, then you can always go back to the research you've done, and the investors like to see that you've done your homework. Of course, in a financial plan, the rest is, you know, is classical. You know, you need to calculate your cost of goods sold, your overhead, your capex, and then especially calculate also the money you need for this phase. Yeah. Plus some reserve. What do I mean by that? I've seen many people that came to us and have come to us that say, look, I need 5 million rand, or I need 3 million rand, or 100,000 euros. And if you give me that money, then I can do this and this and this and this. Yeah. But it's not reflected in a business plan. It's not calculated. And I need to know, as an investor, you know, what is the cumulative losses, cash flow rate, cash flow losses, until it goes up and you make a positive cash flow. Then the cumulative thing is what I call the deepest pit. That's actually is your working capital. And take your working capital plus your capex, plus like 10 to 15% of reserve, then actually you have calculated in a decent way the money you need. If you do not come with a calculated with a calculation that proves why you need that much money in this phase, then actually my hunger to invest in your company is already waning down. And no extreme hockey sticks. You know, the hockey stick, we can go to next slide now. See like revenue growth, you know, as I put in on that arrow, the miracle happens here. You need actually a much softer hockey stick. Of course, there's a hockey stick. You start from zero. I want to build up possibly a multi-billion-dollar company. So you need that hockey stick, but it needs to be moderate, and the inflection point actually needs to have its reason why at that moment you will actually have a bend in the curve. Next slide. And then, of course, as I said already, importance of research. For me, it's mainly calculating the total accessible market. That's showing you that you do the homework, proving you know your market, and find also comparables, in markets and products, and showing also, your competition. I've had many people asking for money with us that actually did not know very well their competition. In the second or the third conversation I have with them, I do some research myself and question, what is this company doing? Is a competitor of yours? Why did they reach that level in the market already? How will you compete? What is your unique selling point, etc., etc.? Next slide, please. And of course, valuation methods. There are a zillion ways of valuing a company. For me, I can give a theoretical academic exercise, and then we need a couple of days. You should be able to value your company in a decent way with a simple calculation. Some companies do not produce, like in biotech, for example, in the first 4 or 5 years, they do not produce EBITDA. They do not produce profit. Well, in that industry, then actually it's IP based. You have also some businesses that want to get market share as fast as possible, like Amazon. Amazon did not produce any profit in the first 10, 12 years of their existence. Then actually it's another calculation, but there we're talking about American situation, where you can pour hundreds of millions of dollars into one company. For me, the best way of valuing a company is a multiple on EBITDA in late series. When you have already series C or D, then you take your last EBITDA of the last year or the last couple of quarters, and then you do a multiple on that EBITDA. And for the people unknown with that term, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And actually, it's quite simple. It's cash flow. It's actually cash in minus cash out. So if EBITDA is positive, then a multiple on that EBITDA in the later stage of the company is actually a good way of valuing a company. In the earlier stage, as all of you are, before you actually produce positive EBITDA, positive cash flow, then actually based on your financial plan, you can do and that's for me the best method, kind of what they call a DCF calculation, which is discounted cash flow calculation. I will show you. Next slide, please. So let me give a practical example, and we can send you a spreadsheet later on where you can copy paste the numbers and the formulas, not the numbers, the formulas. In this example, I took in year 100,000 in EBITDA, yeah, and it goes up to 20 million in year 5. It's just a theoretical exercise. So the straight exit value, if we take a multiple on EBITDA of 5, yeah, then the straight exit value is that times 5. It's 500,000 to second year to 2.5 million, 5 million, etc., etc. And with the formula you can get from us, yeah, you can calculate what actually is the company worth if we calculate it back, discount it back. Yeah. In this example, just a minute. In this example, yeah, I took a discount of 50%. That means that what is that discount? That discount means that an investor, if he or she invests in your company, has a return of 50% cumulative year per year. You can see it. I calculated backwards that percentage in the last column, yeah, and you see that every single year cumulative, the investor has 50% of return, and the 50% covers what? The 50%, what they call discount. The name says it itself, discounted cash flow. Calculates first a decent interest, yeah, usually the interest you pay on a bank loan, and then secondly, it calculates mainly the risk, yeah, and thirdly also kind of, you know, illiquidity. You know, they're getting stuck in your company before they exit, so they're illiquid with that money for 4 to 5 years, yeah. And it's not unusual that certainly in the States most of you are, that the risk factor is that high that investors calculate a 50% discount. I will show it next slide. Yeah. So the two parameters in your valuation is the discount, yeah, and the multiple on EBITDA at the end of the road. What is this multiple on EBITDA? Like you see in the second spreadsheet, yeah. It's actually if you would, I call it straight value here. If you would sell it, the company, after 1 year, yeah, making 100,000 EBITDA after 1 year, then actually the company would be worth 500,000. And if you calculate it back then in the DCF calculation, yeah, on the bottom of the spreadsheet, you see then that the valuation is 333,000. Yeah. So, but of course the valuation is much higher. Yeah. If you take a higher multiple, you know, times 6, times 7, times 8, etc. Don't dare to go in the times 10. For me, it's between times 5 and times 7 in negotiations, dependent on the level of recurring income. You know, the higher it is recurring, you know, income, the better multiple you have. Multiples of times 10 EBITDA is actually between 10 and 20 times EBITDA is for companies that are already quoted on a stock exchange. Yeah. So if you need to have a bit more explanation, we can get online with you out of the foundation. You contact Paige and or Christoff, and we can explain you. The best thing, if you're interested in that kind of calculations, it's a simple way of calculating, but then actually we can send you a spreadsheet where you take that spreadsheet and instead of the EBITDA you're putting in there, usually it will be year 1, 2, perhaps 3 that you're negative, so that doesn't give any value. But then year 4 and 5, at least you should show quite a bit of cash flow positive results. Yeah. Next slide, please. And last thing, of course, and we can give a seminar on that, you know, and I think there's a poll later on, and Christoff, about what you want to see in a seminar. Actually, I can give a seminar about the do's and the don't do's in negotiations with investors, yeah. Or I can give a seminar about, you know, preparing for due diligence if you're in that phase, yeah. So just let us know. Okay? For me, it's a matter of be ready. You're negotiating with investors. Be ready already for a due diligence. That means you need to have all your documents, set up in an online data room. For example, Dropbox. Everything centralized there. Your pitch, your financial plan, the CVs of the founders and the key personnel, all the contracts. You know, if you rent some space, the contract, MOI, the bylaws, memorandum of incorporation, shareholders agreement. Please have a shareholders agreement in place between the founders. Employment agreements, if you have IP protection, the proof of it, major sales contracts, etc., etc. So be ready, centralize it. So the moment they ask for it, you just say, okay, I'll send you a link, a Dropbox link, for example, and there you are. If they ask for more, you can give them more. But think anything and everything that you have on paper that they can ask for, put it into a central place online. That's my advice. Next slide. Well, of course, deal structure. There's also a zillion ways of structuring a deal with your investors. I'm actually a big fan of convertibles. What is a convertible? You have two kinds of convertibles: convertible debt or convertible preferred stock. It's actually when you have a business plan that shows quite a bit of profit, cash flow profit, EBITDA, in the years to come. Sometimes I call it myself. I see something like that. Sometimes we have moonshot valuations. And if the explanation as an investor, if I hear a narrative that is convincing, but it's still very high valuation, then I say, okay, let's agree on a preliminary stake. That actually later on converts into a final stake in the company, which means then that it's based on the result. At the time of the exit, or after 4 or 5 years, for example, you convert based on the results of the last year. And if you reach those results cash flow wise, then actually you keep your stake, or even you as a founder can have even a better stake. It's all dependent on the formula and the conditions, but you see the concept. It converts, and it's fair. It's fair because if you do not perform as you promised, you promised a moonshot valuation, you promised actually higher returns. If you do not reach it, it's fair towards the investors that actually you give back some shares once the trigger date is there. Trigger date being an exit or after 4 or 5 years, for example. It's always accompanied by what I call a floor and a ceiling. A floor is the valuation you do not go below. You say, okay, if it goes below that, then I do not give more shares to you guys. The ceiling is of course that's for for the investor, protecting the investor, is the valuation that I, as an investor later on, when the conversion happens, I will not pay more than that ceiling. If you need some more explanation about that, we can get online or even give a small seminar about that. It's a very positive signal to an investor of belief in your business plan and in your business model. For me, it's a win-win. You can, if you perform better than you project in your projections, then actually you can even get more shares. If you do worse, okay, that's fair to the investor. You promised him a moonshot return. It doesn't happen. The investor gets some shares back. Next slide. And that's about it, guys. Christoff, up to you.
Well, Paul, I think that was more than a mouthful, more like a meal to digest. So I'm not sure about the rest of you, but there's some gems in here, specifically from the perspective of not what the founder would be looking for, but what potential investor would be. I see that we do have some questions coming. In fact, there are about 8 questions. So if you have a question, click on the Q&A button and post your question there. I'm sure they're questions, by the way. So don't be inhibited. You can even post your question anonymously if you don't want us to know who is posting the question, so we can address that. And I see there's also some activity there on our text chat. So Alexandria, if I can ask you to switch on your camera and unmute yourself. Let's have a look at what the text chat has been about. If I see you unmuted, just click, there you are. Okay. So you've been monitoring what's been happening there in the text chat.
Yes, and also the Q&A as well. Okay, so you just want me to go over the questions or just what's happened in the chat?
Well, we can get to the questions too, but perhaps just some observations about what's happening in the text chat. Have people been able to even start a conversation there around some topics?
Mm-hmm. So most of the chat had like introductions from the different people that are participating in the masterclass today. And then they had a couple of questions, but then those questions have been moved to the Q&A. So I wrote down all of the questions, and then I don't know if we can start discussions surrounding those questions.
Okay, so we'll just jump into the questions then. But before we do so, let's ask another question for everyone in the room. So this question is about what are the most pressing challenges you face in raising money? And yeah, you can choose more than one. In fact, try to limit it to about 3, but if you have 4 that you want to select, you may do so too. So the question is, what are the most pressing challenges you face in raising finance? And there are some options for you there. We do not know who the right investors or financiers are. We are unable to connect with the right financiers. Financiers do not understand our business model. We can't show enough market traction. Investors think our team is too inexperienced. Investors do not understand startup African conditions. We do not have access to reputable market intelligence. The competition in the financing market is very stiff, and accelerators do not prepare us enough. Or if there's something else that you want to note as a pressing issue, you can also put that into the chat. So let's see if you vote what your pressing issues are, giving us an idea of what the topics are, perhaps even for us to focus on in the future to support you in solving those issues. As the voting is happening, it looks like we are unable to connect with the right financiers is the most important one. So that would indicate that people know who the financiers are, but they are unable to connect with them. It's kind of like a matchmaking solution that is needed. So in fact, 75% of us in the room that have voted are saying that we are unable to connect with the right financiers. A few do not know who the right ones are, but by far the most say in the room today. I'm going to end the poll now, and then I can actually show it to you too. So I can share the results. You should be able to see that now. So it is 76% of us are saying we can't connect with the right financiers. That seems to be the most pressing issue that we're facing. So let's see how that relates to what we have as questions. So Alex, if we can come back to you. So which of those questions would you want to address first?
Okay, so just opening up the discussion and I talk about it. Hello?
Yeah, so we've got some anonymous questions. Emma, Jones, Mvelu, Charles, guys, Sivior, Kennedy, thanks for posting your question. So if anyone else has a question, please post it by clicking the QA button and not type the question in the chat. The chat we use for this discussion. The questions we'll focus on. So by the way, it is now 1 o'clock CAT, so we've got about half an hour to go in addressing questions. Enough time for us to do so. So if you have a question, please post it there. Paul has covered a lot of ground in the time. In fact, you know, there's some topics in that I thought, yeah, we can definitely kind of organize another event around just that topic, sort of. So maybe we'll do so. But please post your questions if you have any, and then we can address them in our discussion now. By the way, if you want to come into the room to talk about your question, I see Sani has got a hand up. You can actually raise your hand too. So you see there's a button that says raise hand. If you want to come into the room to describe your, so there's Emma already putting up a hand. So Emma, we're going to bring you into the room. But in the meantime, Alexandria, is there a question that you have noticed? Not the one from Emma?
Yes. So one of the questions I noticed was connected, which is one that they posted as the most pressing challenges. So being able to connect with the right investors. So I guess who are they and how can I get access to them? And then another one that I saw was
Shall we tackle that one so long? So I'm not sure. Do you want to try to give it a bash, Alexandria, from your perspective? Sort of if you get that question, what advice do you give people?
What advice do I give them if they're trying to look for the right investor?
Yes.
So personally, that's not really my area of expertise.
Is there someone in the Tony Elumelu Foundation who you can refer them to?
So yes, we do have someone that we refer them to. So we have a partnerships team within the foundation, and they work very closely with the alumni engagement team to try to connect our entrepreneurs with access to additional resources and access to additional funding and access to additional opportunities. So usually what happens is that we would hand them over to the partnerships team, and the partnerships team will help them to connect them to the right investors. But then what the entrepreneurship, what our team does is we try to prepare them by making sure that they're investor ready. So opportunities like this where they can have master classes where they can learn a little bit more about how they can prepare their businesses so that when we do connect them to potential investors that meet their needs, that they're ready.
Yeah.
That's what we're going to do, but it's not, I wouldn't say it's necessarily our area of expertise.
Yeah. So Paul, maybe if I can come to you, there are definitely certain matching of yourself with the potential investor that you need to make.
Well, first of all, the fact that the poll shows that this is the major problem, perceived problem, is for me a sign on the wall, again, that there is not enough investment money in Africa. That's first of all. So we have a very important role as venture capitalists only for Africa. So that's what we try to do. For us, it's actually as the HWAP Foundation and the HWAP Fund, it's all about creating money to invest in African companies. African companies in many ways. If I look at the products I'm seeing, the novel products and the creative products, sometimes way better than what I've seen in Europe and the United States and the US. But there's not enough money. Then secondly, my answer to that is also research. Do your research, on anybody and everybody you think that can invest in your company, and don't limit yourself to your country. Look at different countries. Look at Europe. Look at the US. Look at China. Whatever. Lots of things are available on the web. For me, it's a matter of statistics. If you that's selling. The more contacts you have, and the more chance you have to find the right investor. If you can contact 50 of them, contact 50 of them first, and you need to have a funnel, of course. You cannot have every day 5 or 10 pitches, but try to set yourself a goal to do at least a couple of pitches per week, if possible, perhaps 1 pitch per day. So the more opportunities you create, the better you will be able to find the right investor. That's actually my advice.
Yeah. Great stuff. Thanks, Paul and Alex. Ama, I'm not sure if I pronounce your name correctly, but you can correct me if I'm wrong.
Yes. Ama?
Welcome. So you've got a question that you posted, but you can ask it live too.
Okay. So I think a couple of questions actually. So one was, and it was related to this finding the right investor in your sector, industry specific. I'm in publishing, for example, digital publishing, and I sort of need investors who understand digital and the potential for digital. It's difficult to find, and so, but I've taken the point about talk to as many people as possible, but sometimes you're trying to talk to investors who are not used to your industry, they're not used to digital, and how do you talk to them? How do you convince them about the potential? So that was one question. Then when you're looking at the angels, and I think I'm at that stage, how many is a good number? Is it okay to get 4 or 5 angels investors? Is that too many people at that stage? Or at this early stage, it doesn't matter how many angel investors you have? Is there an optimal number?
Yeah. So Paul, you want to give that a bash? Thank you, Alma, for also coming into the room. So by the way, if there's anyone that's got a comment or some tip for Alma in terms of your own experience, you can use the chat to actually give some advice as well. There may be a lot of knowledge that's sitting in 30 odd people that we are in the room now. So please participate also by giving advice. We've got experts in the room, but some of the experts are those that will be participating through a text chat rather than to speak. So please comment in the chat area if you have an answer to any of those questions. But Paul, yeah, so industry specific and early stage angel, sort of, is there a limit to the number and who we should be going to?
Well, let me address the last question first. If you have too many investors in your first angel round, then for an investor, a professional investor that comes after that, in your next round, they don't like it. I had it several times in my own time when I was looking for money, when I had several times myself with people coming with a startup for investment in the next round. And if they had, I have somebody here, even in Belgium, that asked for investment. And he has about 20 and something angel investors. I will never invest in that company. Never, ever. I mean, before they reach a decision, they need to speak to 20 and something people. Even 4 or 5 can be high. There's a solution to that. That means you can actually have some angel investors if you have a bit too many. Like say you have 10 potential investors with smaller amounts of money, and the sum of that money is enough for you to start up. Then in your investment contract with them, put in the contract that you can buy them back at a certain return on investment, which should be, of course, a bit higher than they can get as interest rate from a bank. Usually it's at least double what they get as interest rate of in a bank as a compensation of the risk they're taking. But then if you have that clause in your contract, then actually the next round you can say, look, we needed that money before the big guys are believing in our concept. We needed that money, but in our clause we've put a buyback in. Then an investor will find it smart. They will say, hey, that's great. They anticipated on our needs to not have too many people in the kitchen. So try not to have too many, and if you have a bit too many, try to put that in the investment contract. Now, to address your first question, and I tried to address it earlier already. If you are like in a publishing business, don't limit yourself to African publishers. We had, I remember, Christoff, we had one potential investee in South Africa that was in the publishing industry. And they were already a bit more advanced than a startup. Actually, we connected them to two big publishers in Germany. Yeah. So look, my advice is, don't look only in your country, don't even look only in Africa. Look to European and American and Chinese investors. Yeah. Do your research. That's homework. Means do your homework in getting as much as possible suitable investors. Yeah.
Great advice. I liked your first advice around angel investment, Paul. In fact, if there's anyone in the room now that wants to tweet that bit of advice out to the community of founders, please do so. You know, sort of when you sign up angel investors, you know, sort of allow a clause in your agreement with them that you will be able to purchase the shares that they have back at a determined price. So that when you take that big step with a first round of proper investment, you've got a way to deal with the concerns of that bigger investor in the future. You know, sort of a lot of heartburn can be saved later on just by that simple piece of advice. So that's my gem for the day, by the way, Paul, is, you know, sort of a lot of our audience is in that space of angel investors, and they're so thankful that that bit of money is coming into the business, and they agree on the shares without thinking what's going to happen in next rounds of investments. So thanks for that advice. Make sure that you have a described way for them to exit, and that you can actually enforce that exit when you get bigger investors in.
And put it in a contract, in an investment contract. Exactly. Yeah, but put it on paper signed. Yeah. Because
so thanks for those questions, Amma. Before we get to you, Bakuena, we'll come to your questions just now. But I want to ask Alexandria if there are any other questions that you would like us to focus on first.
I think a follow-up to the question that Amma just asked about finding a suitable investor. So Charles just asked a question about that he actually has two investors, and then he's trying to figure out how to choose the best investor out of the two. Is it based off of which one is giving a larger investment, or is it the investor's market knowledge and access? How do you make that decision as a startup that has multiple investors? To follow up on that.
Right, Paul?
Well, from here, if you have two investors, in this case, separately, continue negotiating separately with the two of them. That means you have an alternative. If one drops the ball, then actually you can pick up the ball with another one. Yeah. And if they are both so hungry, it can drive the price up. That means your valuation goes up. And as I said in my presentation, you know, people smell if you do not have an alternative. And if you are, the longer you negotiate, the in more dire straits you're becoming, because you need the money. Yeah. So it's a matter of negotiating with two or even three investors. And if they're so hungry and they even want to be in, well, why not put them together in a consortium? Yeah. And then you have two investors, two or three investors. That has several advantages. I've did that before. I had three investors. Actually, I had 6 investors in a company I brought to the Nasdaq. In the beginning. So then we ended up making 2 consortiums even of 3 and 3. And one of the consortiums won the bid. That created a very good valuation for us. But there's another advantage. Yeah. If you go for a next round, your 2 investors that are in that consortium do not find it too difficult to participate even in the next round then. They do not have to put down that much money because it's already half-half if they are with 2 or 1/3, 1/3, 1/3. Yeah. And then thirdly, they all want to have to be a board member, the board membership. Then actually you have much more, and that's a positive. You know, board members bring advice and knowledge, experience to the table. That means then you do not have 1 or 2 added value people in your board, you have 2 or 3 instead of 1. Yeah. And about how you position yourself in a board and a majority in the board, etc. That's even a separate seminar, to have effective board meetings and keep the control in your board. There's two ways of control. You need to have majority in your board, and you need to have majority in the AGM, if possible. Okay, I can talk about.
So rather than start a bidding war, get them to pull together. I think that's kind of the essence of your advice.
Absolutely. But negotiate first separately. Yeah, because if you put them too early together, they will actually talk between each other and try to get you down in your valuation. Try to get the highest valuation, and then actually once you have their bids, then put them together. That's my advice in time.
Right. So Bakwena, I hope I pronounce your name correct, but let's hear what your question is today.
Hi guys, thanks so much for actually inviting us to be a part of this. It's very valuable information. Thanks Paul, Chris, and everyone. So I actually have 2 questions. The first question is, in a situation where, like Paul was addressing, having too many angel investors, can you use, so my question is, can you use an up and coming investor's money to buy out your angel investors, or are you supposed to use your own money to be able to do that? And then the second question is around, so we are a South African tech startup in the analytics space, and one of the challenges we've faced so far is around market access, because we are a B2B, so we want to be able to get into those spaces and chat to the right people, but we have found that to be extremely challenging. So how do you, so what we essentially want to understand is, with an investor coming on board, is it advisable to go for someone that already has connections or the network to be able to connect you to some of the guys that can help you accelerate your growth in terms of getting customers in, or should you just use some of that money to get our sales team going and for them to go out and get into the ground and get the sales going? Thank you very much.
Well, to address your first question, with angel investors, usually an investor in the second round doesn't like to put money on the table to buy back another investor. Unless you have a reasonable deal with your angel investors to buy them back. And then reasonable for me is actually at kind of a double interest rate. Interest rate you pay to the bank for a loan, and then you double it. And then the second part of that same question was actually, do you buy them back with the money of the investors, or do you buy them back personally? My preference goes personally, but where will you get the money? To buy them back personally. So you can go on let's say on a financing round for yourself, for personally. But then I mean that's 2 negotiations. One personally to finance yourself, because if you're able yourself to buy back those first angel investors, you're less diluted. You get even more shares in. But that's kind of a difficult thing. Another way of doing things, that I didn't mention before, is actually, say you have 10 angel investors. Then if they want to stay, or if your next round investor doesn't want to buy them back, you put them all together, your angel investors, in another juridical entity, kind of a holding company, where they put their shares in, and then it's only one party. There's one CEO then of that holding company, well, CEO of or whatever responsible, that the new investors only have to talk to one person, and that one person actually should preferably be you, because you represent those angel investors. Or you make an agreement that the 10 choose one of the 10 as a representative. So that means that instead of two voices, you actually eliminate that problem by putting them all in one entity and have one voice. Yeah. So that's for the first question. The second question is actually to grow your business, if I understood it well, and you cannot get access, enough access to your to the market. Well, in that case, I would like to see your marketing plan, because something could be wrong with your marketing plan, or with your product, or with your business model.
So Paul, I think the question is could gearing up with the investor lead into access, especially in the B2B space, which their business is? Could you see as getting an investor involved that will actually give you access to that B2B clients that you're looking for too?
Absolutely, absolutely. That's one of the criteria of, if you have the choice of investors. The one with the, of course, as I said before, the chemistry needs to work, but the one which has the best network in your industry, is the one I should go to. Because those people open up doors. And sometimes if you want to sell, if you come out of the blue with a cold call to try to sell, it's so difficult. But if somebody is already has inroads in a company because they are in that industry, or they financed in one of the rounds some of those businesses, then actually it's a win-win.
Great stuff. So we're clearly not going to be able to address all the questions that we have, but we'll give a good bash at some of them. So Alexandria, are there any other questions that caught your eye? I saw Kennedy asking about whether it's okay to buy the BMW with the money that you get from your investor. But Jones had a more serious slant to this. He was asking if it's important that founders must get paid, so that we're as a salary, sort of from early on. So Paul, maybe if you just want to comment about that. And then Alex, I'll come to you now in terms of other questions that you noticed that we should address still today.
Okay.
It's a very tricky thing, of course, the salaries. Of course, we all need to eat. Yeah. That means it should be enough to live. Yeah. But don't exaggerate. I mean, I've seen all kinds of things in salaries. A big chunk of the money is getting in, is then used to. I'll give you an example. It's not only salaries; it goes for the car, etc., etc. Just to give an example on the BMW that somebody mentioned there. Yeah. I invested in a company in France, actually, in the past. Yeah. And that guy had actually connected us to Bill Gates. Bill Gates, who ultimately then invested in our company. And for me, we invested. I don't remember. It was like €1 million, something like that, million and a half euros in that vicinity. Yeah. And the money invested, and I looked at it more as a write-off, because his value was actually our connection to Bill Gates, But the nice thing, well, not nice thing, the story I want to tell, we saw him then in Palo Alto in Silicon Valley, and the first meeting we had, we were standing outside of the restaurant, having a smoke, and we saw, his name was Alex, we saw Alex coming, with the biggest possible BMW that he just had bought, with our money. So the same is valued, of course, for salaries. Don't exaggerate. Of course, you need to live, but it shows if you put in your financial plan that your salary is tied to the results. Of course, you have a flow. I need X amount of money, to be able to live off decently. Yeah, but then if the salary is tied to results in your financial plan, as an investor, I like that. I say, okay, the minimum you need to live off is like 1,200 euros or whatever. Yeah, 16,000 rand or 15,000 rand a month or whatever the currency, naira, whatever you choose. And everybody knows what the salary is, you know, in that country. There even are statistics and websites to look at for that. But then, if I see that the salary is actually tied to the results, if you're positive results, you know, meeting some thresholds, then actually I like that as an investor. So be very careful how you do that. Yeah.
Great, Alexandria. What else should we answer? I'm by the way typing away some answers that I can provide in the Q&A, but what else should we discuss? We've got a few minutes more to do.
Okay, so one question I saw from Femi, he was asking, or she was asking, how do we find the EBITDA multiples in Africa where the data might not be available? And then they also asked, the discount rate of 50% seems a bit high. Is this the rule of thumb for Africa? So that's one question. Maybe we can answer. Maybe Pol?
I didn't hear it very well. Christoff, can you rephrase the question, please?
Sorry, we all speak in different accents, eh?
I can try again.
So do you want to give it a go again? It's a Femi's question about EBITDA and the multiples. So how do you select, what is the right multiple? He talks about discounted cash flow forecasts, I think. And what is the right multiple to use in Africa? So can you just translate the industry from Europe to Africa if you calculate those discounts?
Well, well, it's two things. Either is the question about discount, or is it on the multiple on the EBITDA?
He's asking, how do we find the EBITDA multiples in Africa where data might not be available? The discount rate of 50% seems a bit high. Is that a rule of thumb for Africa?
Well, the 50% is discount. It's not multiple on EBITDA. If you talk about discount, 50% for a startup, yeah, is something I use quite a bit. Yeah. If of course you have already lots of traction, etc., that's different. Yeah, if I see already a lot of traction, you're creating quite a bit of revenues already, you're close to profitability, then of course the risk factor is much less. Then we're talking about 25, 30%, 20%, if you're very lucky, and already lots of traction. But for a real startup, yeah, that produces the first traction, for me, a discount of 50% is reasonable. And be prepared. Yeah? If you make your financial plan, put another tab for yourself. You don't have to share it with the investor, but put another tab in a separate safe of your spreadsheet. Put another tab, valuation. Yeah? Page can send you the spreadsheet I was showing. Yeah? So you can just use that, and instead of the theoretical numbers I've put in 100,000, 500,000, etc., you link that to the results in your own business plan, and then you can see whatever parameters you change in your financial plan. You can see, oh, if we can reach this profitability, then actually our valuation is much higher.
Yeah. So yeah, Paul, so maybe since we are running out of time, I just want to sneak this one from Jacques in about valuation of IP, since we're talking about valuation now. So he's asking then, if we can't use discounted cash flow so on for IP valuation, how is IP valued?
Very difficult to say, and my experience is quite limited in that. But I know from an ex-partner of mine who was fully in biotech, Christoff Erik, you remember. The valuation is actually about how close you are, yeah, with your IP, yeah, how many patents you have, yeah. Is the industry where your patent is there, is it actually a booming industry or potentially booming industry? Is it are you close to, for example, an FDA approval in the United States, which is very costly, etc., etc. So that kind of stuff determines for me the value. And then actually, it's again, instead of calculating it on 4 to 5 years, at a certain point in time, you need to calculate once you will make money, and then actually, then you calculate your DCF or whatever method you use. You calculate it on a 10-year business plan, which is like 4 or 5 years developing the IP and then starting to sell the first products after necessary approvals after 4 or 5 years. Then actually you need to calculate a 10-year business plan.
Great. Shall we sneak in a last one? It's already half past. So I'm not sure, or shall we just go for final comments? I'm sorry, guys, if we didn't get to your questions. We really love to answer all the questions, but we are limited for time. So, Alexandria, is there a specific question you think we should focus on, or can we start wrap up?
The last question I'm seeing here, it might take a little bit long to answer, the one by Anonymous. But I don't know if we can have time. So it's basically asking, how do we value your current business to prospective investors, and how to determine how much an investor gets in shares of your business, to how much they're willing to invest? It's something that we kind of went over throughout the masterclass today. So I don't know if we would be able to just give some last thoughts on that. What do you think?
I think maybe we can save that for a topic for a future class. Yeah. So let's take these questions. We have the questions. We can incorporate them into future topics for our masterclass. The plan is that we do this every month. So since you have now registered, we've got your email address to invite you to the next. We will have the details out soon. In fact, we've got our planning meeting later this week to plan for that. So let's just go around the table. So, I mean, I said it so earlier, you know, sort of my big insight here was sort of Paul's tip on early stage angel investment. Sign a contract with them that allows them an exit at a predetermined rate, so that by the time you do a Series A or Series B, you actually are covered in allowing them to exit in a pre-agreed way. So that's kind of my big takeaway for today. I'm not sure, Alexandria, what your big takeaway is. And then we can allow Paul perhaps to kind of just give us a summary of where we are at now in terms of what we did in the masterclass. So, Alex, what insight did you gain?
I learned a lot. Like I said, my area of expertise is not necessarily about in terms of investment and how to approach investors, but I'm learning a lot. And I think this will be helpful for when entrepreneurs come to us and are asking questions. I learned a lot today, so this is really helpful for me. I'm also learning. So I had a lot of takeaways today, actually.
Yeah. Great. Cool. So for those, by the way, we all stayed in the room till now, so it means that there's some value. I just want to ask, if you don't mind, each of us, there are in fact 32 of us now, just type into the chat your rating of how we did in terms of your expectations out of 5. So 5 would be you've never had such a good webinar or seminar that you attended in terms of informativeness and usefulness. 4, it's good, but not the best. 3, it's kind of middle of the range. 2, we didn't do well. And 1 is really, it was a waste of time. So if you can just type in there, and we know that there are 32 people in the room, so we're gonna look for 32 answers there. So just quickly, while Paul is giving us a wrap up on, preparing yourself for investment and understanding what investors are looking for. So Paul, your last swan song on this topic.
Well, as you said already, I was very pleased that 32 people were in the room and stayed in the room. So that means we have to say something. And for me, it gives that much joy to share what I've learned during those almost 50 years in business, through lots of mistakes, big ones as well. One of the things that stays out is that first poll you did, which means that hello, are you still there?
Yeah, we're still here.
Okay, that means that more than 70%, if I remember well, of the people here present voted that they do not have access to capital, and that's actually a big sign. And that we are on the right track to we're in negotiations with the European Community, etc., to get more money into Africa for investment, and that's actually we're on the right track to do so, because there's so much creativity, so much good products and services out there, and so much entrepreneurial drive. Africa within 10, 15, 20 years from now will be the economically wise and entrepreneurial wise the best continent in the world. For me, it is already that way, but quite a way to go in financing. But undoubtedly, within 15, 20 years from now, Africa will be the place to be for investment. For me, it's already that way, but still quite a way to go. Yeah.
Great, Paul. Thanks for that. And together we can do stuff. So as the contributions are that we can make to different in different ways of growth in the entrepreneurial space, we can do so. At the HWeb, we say we promote viral entrepreneurship. So it's not about us only gaining ourselves as founders of our businesses, but it's also about passing that gain on to some others. So as we get investment to reinvest into some of our smaller businesses that are supplying to us, as we get mentorship or benefit from a masterclass, to pass on that message to others that we reach to. So perhaps there's a challenge that I want to put out there to everyone in the room here. Think who you can share with what you gained here today, so that idea of viral entrepreneurship can be something that's practiced by all of us. So great, we had our first masterclass. Alex, we'll do our planning for our next one later this week. And everyone, look out in your inbox. You'll receive an invitation. So go out and build your business to something valuable that not only you can benefit from, but also your investors. Cheers, everyone.
Thank you, guys.
Thank you.